The dollar is sitting around 129 shillings right now, and that changes everything about how Kenyan traders fund their accounts, manage risk, and withdraw their profits. Is this an opportunity? Yes. Is it a trap? Also, yes. Let's break it down in simple terms. First, what does USD KES equals 129 even mean? It's simple. USD KES shows how many shillings you need to buy one single dollar. So if the rate is 129, you need 129 shillings for $1. When the shilling strengthens, that number falls or stays low. When it weakens, the number rises, like when we saw it go past 160 before the big rebound. So, why is this 129 zone so important? Well, Kenya's shilling has stayed pretty stable around this level for most of 2025. Traders are pointing to a few key reasons: diaspora remittances sending dollars home, strong tea export earnings, and the central bank's support in the market. Now, stability doesn't mean zero movement, but it does reduce those extreme, unexpected shocks. That makes planning your trades a whole lot easier. Now, let's talk about funding your account and why it feels cheaper in shillings. If your trading account is denominated in US dollars, you have to convert your shillings to dollars when you deposit. At a rate of 129, your shilling cost for every dollar is much lower than when the rate was 150 or 160. What's important to remember is that your broker's margin rules in dollars haven't changed at all. But your shilling equivalent cost to meet that margin definitely has. For example, a $100 deposit now needs about 12,900 shillings, instead of the 15 or 16,000 shillings it would have cost you back then. Okay, so what about when you withdraw your profits? When you take out profits in dollars and convert them back into shillings, the math changes again. At a rate of 129, each dollar you withdraw converts to fewer shillings than it would have at 150 or 160. This is huge, so you need to plan your withdrawals carefully. If you have expenses you pay in dollars, like for online services or subscriptions, you might want to keep some of your profits in dollars to avoid unnecessary conversion fees and rate changes. With any big market shift, there are always winners, losers, and those in the middle. So who wins here? Kenyan traders funding their USD accounts in shillings. You get a lower local cost for every dollar you deposit. Who needs to be cautious? Freelancers and businesses that rely on a weaker shilling might feel a pinch, as they'll receive fewer shillings for every dollar they earn. And who's neutral? It really depends. For importers and exporters, the impact varies based on their contracts and how they've hedged their currency exposure. If your business has significant exposure, it's a good idea to talk to your bank or a foreign exchange dealer. For all the beginners watching, here's a quick risk management checklist for this environment. First, always size your trades in shillings. Know exactly how much you are risking per trade in your local currency. Second, set your stops first. Then think about your entry. Decide the maximum loss you are willing to accept before you even click buy or sell. Third, remember that fees add up. Conversion fees, withdrawal fees, and spreads, tafadhali, check them all. Fourth, avoid over-leveraging just because funding feels cheaper. The rules of the game are still set in US dollars. And finally, stay updated. Check the CBK indicative rate and a reputable market source every single day. So here's the bottom line. A rate of 129 shillings per dollar is a reset button, not a promise of easy money. Smart traders adapt their funding strategy, their withdrawal plans, and their risk management. Bila hype. Forex si machezo bro, ni plan. Thanks for watching. If this helped you, hit that like button and subscribe for more content that makes sense for Kenyan traders. Catch you in the next one.